Welcome to the Deep Dive, the show that's really engineered to cut through all that noise and give you the essential intelligence you need fast. Today, we're tackling a specific request, actually a deep dive into the source material on Cognizant Technology Solutions. That's ticker CTSH. This one's customized just for you. And our mission here is, well, it's to get to the bottom of a real market puzzle. AI is changing everything in IT services globally. So the big question is, has Cognizant actually managed to pivot? Or is it kind of stuck with its old ways? We really want to figure out why the market seems so down on this stock. Because honestly, when we run the numbers, the intrinsic value looks like it's somewhere between $85 and $95 a share, which is, well, way above its current closing price of $68.03. That was as of October 31st, 2025.
Exactly. That gap, that potential upside of, what, 25% to 39%, that's
Yeah.
the core tension we need to explore. Is the market seeing some catastrophic risks that maybe aren't obvious? Or is this actually an opportunity based on a turnaround that people just haven't appreciated yet?
No.
So we'll need to dissect, the business model, its financial health, what management strategy actually is, and of course the risks involved.
Right. And just a quick note for everyone listening, this kind of deep analysis, this is exactly what our members get all the time. So definitely like and subscribe to Stock Analytics AI. For just €4.99 a month, you get access to a whole playlist, 500 deep dive videos covering the S&P 500. And we're rolling out the NASDAQ 100 coverage next, which is pretty exciting. Plus, members can request specific stock deep dives. Just drop the ticker in the comments and we'll get on it for you.
Okay, so ready to unpack this. Roughly $33 billion operation.
Absolutely. Let's start with Chapter 1, Business Analysis. Navigating the AI-driven transformation. Okay, so at its core, Cognizant is, well, it's a pretty classic professional services giant, right? They focus on consulting, IT services, and also business process outsourcing, BPO. And they serve these big companies across four main segments: financial services, health sciences, which seems to be a huge growth driver for them,
Definitely.
products and resources, and then communications, media, and technology.
Yeah, and the first thing you kind of notice when you look at those segments is the geographic risk. I mean, their strong Q3 2025 revenue, that $5.42 billion you mentioned, was heavily driven by North America.
Right.
Now, that shows strength in the U.S. market, sure, but it also means they're really exposed to U.S. economic cycles. And policy shifts, too. Like, think about the U.S. imposed tariffs of 2025. Those can bump up IT hardware costs, which might make their clients, postpone big tech investments.
That concentration risk is definitely something to watch. But maybe the bigger challenge is this AI pivot they're attempting. They seem to be trying to shift from a model based on, let's face it, cost arbitrage, basically cheaper labor, to more of a co-innovation partnership model. They're rolling out their own platforms like Cognizant Neuro IT Operations, that's for simplifying IT infrastructure, and also the Cognizant Neuro AI and Agent Foundry, which is aimed at helping clients deploy generative AI across their whole enterprise.
And this is where the pressure really ramps up on management, isn't it? The global IT market overall is enormous, like $1.52 trillion. It's growing steadily, maybe 9.3% CAGR.
Right.
But AI spending, that's projected to explode at, what, a 29% CAGR? It's a huge difference.
Oh, yeah.
So if Cognizant doesn't nail this transition, they don't just miss out on the fastest growing piece of the pie. Their traditional services, the legacy stuff, could actually get eaten away, threatened.
Which explains why management keeps talking about nonlinearity.
Right.
For anyone not familiar, they basically mean they need revenue to grow faster than their headcount. Why? Because the very AI services they're pushing could, ironically, cannibalize those old school, labor-heavy BPO services that used to bring in so much volume.
It's a tricky balancing act.
Yeah.
Necessary, but definitely high risk.
So what's their defense? What's their competitive moat here?
Well, it mainly comes down to high customer switching costs. That's the big one. Because Cognizant gets so deeply embedded in a client's core operations, pulling them out isn't just expensive.
Yeah.
It can be massively disruptive. Some analysts figure those switching costs could be like a third of what the client spends with them annually.
A third! That's substantial.
It is. That, combined with their sheer scale, they have, what, 349,800 employees globally? That's why Morningstar gives them that narrow moat rating.
Okay, a narrow moat, built mainly on making it painful for clients to leave. But, a moat's only as good as the people defending it. We need to know who's actually steering the ship through this transition. Let's move on to Chapter 2. Management evaluation, stewardship, and strategy. Right, and the story here really seems to be about a major course correction. Cognizant was kind of underperforming, high employee attrition was a problem.
Yeah, it was a big issue.
So their answer was basically to raid the competition strategically. They brought in CEO Ravi Kumar S., who was a longtime veteran at Infosys, and CFO Jatin Dalal, another veteran, this time from Wipro. This wasn't just tweaking things, it felt like a real leadership overhaul, aiming to change the culture, the direction.
And you can see that decisiveness in their strategy, too. Especially M&A, they're doing these tuck-in acquisitions. These aren't just about getting bigger. They're about buying specific key capabilities they need. Look at the Belkin deal, about $1.3 billion. That immediately beefed up their engineering R&D services. And buying Thirdera, that move was clearly about becoming a leader in the ServiceNow space, which is booming right now.
Smart moves. Spending capital efficiently to get into high-growth areas.
And they seem pretty focused on shareholders, too. They're on track to return, I think, $2.0 billion to shareholders in 2025.
That's the plan, yeah. And they've been consistent with dividends, 6 straight years of increases.
Right, yielding about 1.8% currently. And the payout ratio is only around 25%, which is quite conservative.
Yeah, it suggests they feel pretty confident about those cash flows continuing.
The efficiency numbers seem to back that up. Their return on invested capital, ROIC, has been solid. It climbed from about 10.3% in 2020 up to over 13.2% in 2024. But here's the really striking part. Their TTM ROIC, so the return over the last 12 months, it's actually better than 87% of their industry peers.
Wait, hang on. Better ROIC than 87% of competitors? A new proven management team. Solid balance sheet, dividend hikes, but the stock is stuck down at $68.
Yeah.
How does that compute?
That's the disconnect, isn't it? And it leads us perfectly into the numbers themselves.
Okay, let's transition then. Chapter 3, financial analysis, a deep dive into the numbers. So market cap is around $33.1 billion, definitely a significant player. Revenue's been a bit volatile maybe over the last 5 years, but they did raise their guidance for fiscal 2025. They're now targeting between $21.05 billion and $21.1 billion. That implies pretty solid growth, 6.6% to 6.9%.
Which is respectable in this environment. Now, profitability? It's decent, but you can definitely see the competitive pressure of the IT services industry. The margins aren't exactly fat. TTM gross margin is 34.1%, operating margin 15.7%, net profit margin 11.9%.
Right.
And that kind of reflects that broader long-term trend we see across the industry, gross margins getting squeezed over time.
But the cash flow story seems much stronger. That's where the real value might be hiding, right?
Cognizant is consistently generating free cash flow. TTM was $2.28 billion, which gives them a really robust FCF margin of 12.7%. And FCF, well, that's what pays for the dividends, the buybacks, those acquisitions.
Exactly. It fuels everything. And the financial stability. It's almost fortress-like. Seriously, the balance sheet is incredibly strong. The debt-to-equity ratio is tiny, 0.08. That's better than 75% of their peers.
Wow, 0.08 is extremely low.
It gives them massive flexibility. Huge. And the liquidity looks great, too. Current ratio is a very healthy 2.41. This is kind of baffling. A rock-solid company generates tons of cash, run more efficiently than almost 90% of its peers, and yet the valuation looks so depressed. The TTM PE is just 13.8.
Right.
Compare that to its own history. The 10-year average PE was 20.4, and the industry average PE now is way up at 31.3.
It's a huge discount, and that discount clearly tells us the market is pricing in a lot of pessimism. It's worried about execution risk mostly.
Yeah.
The fear is that this transition to AI will just be too slow, too difficult, and maybe margins will get permanently compressed.
So we need to see if the market sentiment actually backs up that pessimism. Okay, let's investigate that. Time for Chapter 4, Market Sentiment, Gauging the Prevailing Winds.
Well, the analyst consensus is a bit mixed, isn't it? Kind of ranges from buy to hold. But interestingly, the price targets are generally quite bullish. The average 12-month target is $85.
Which lines up pretty closely with our intrinsic value range. Exactly. It implies about a 25% potential upside from where it is now, around $68. And recent news flow seems pretty positive, too. They beat earnings expectations in Q3 2025. And they've announced strategic moves, like that expanded partnership with Rubrik for business resilience as a service.
Yeah, the fundamental analysts seem constructive.
Yeah.
But the bears are definitely influencing the technicals right now. You see that in the short interest. It's moderately high, and it's been creeping up somewhere between 5.2% and 6.7% recently.
Oh, so people are betting against it.
Some are. And more significantly, look at the moving averages. The stock is trading below its 50-day average.
Yeah.
And it's significantly below its 200-day moving average, which sits around $75.82.
Ouch.
That confirms a broader, technically bearish, long-term trend. It suggests the big money managers are likely waiting on the sidelines for a clear sign of reversal before they jump back in.
So the value investors might like the price, but the trend followers and the overall market mood are keeping it down. All right, let's see who actually holds the stock. Who has the power here? Let's look at Chapter 5, ownership structure. Who owns Cognizant? Well, this is clearly dominated by institutions. We're talking like 92% and 97% of the shares are held by the big players. Vanguard, BlackRock, State Street.
The usual suspects.
Yeah. And the top 10 holders alone control over 40% of the entire company.
And that kind of concentration, that's a double-edged sword, really. On one hand, having big institutions backing you gives a lot of credibility. Stability, maybe. But on the other hand, if just a few of those huge fund managers decide to trim their positions, maybe because of macro shifts or index changes, whatever,
Right.
it could trigger some serious selling pressure. Volatility could spike pretty quickly.
Makes sense. And what about insiders? The people actually running the company? Well, insider holding are tiny, less than 1%. And if you look at activity over the last year, the pattern is overwhelmingly selling, like 102 sales versus only one open market purchase.
Not ideal.
Now, okay, most of that selling is probably related to compensation, stock options, things like that. But still, it's notable that the new leadership team isn't exactly rushing out to buy shares on the open market with their own money at this price. It doesn't scream confidence.
It's certainly an observation worth noting. Okay, so now we need to pull all these threads together, the internal factors, the external market view, for a final risk picture.
All right, let's do it. Chapter 6, risk assessment. A 360-degree view. Okay, starting internally. Strengths seem clear. They have deep expertise in key areas, especially healthcare and financial services. Big verticals for them.
Definitely strengths.
But the weaknesses are those things that keep cropping up. That heavy revenue concentration in North America, and the historical problems with employee attrition, which the new management is hopefully tackling, but it's still a risk.
Right. And then externally. The opportunities are massive. You've got the whole AI and generative AI boom growing at that incredible 29% CAGR. Huge potential there. But the threats are just as real. Rapid tech change is always a threat in this industry. It can make your old services obsolete almost overnight.
The double-edged sword.
Exactly. And then you have the macro stuff. Those U.S.-imposed tariffs of 2025 could have indirect effects. And just the general impact of a higher-for-longer interest rate environment. That makes it more expensive for their clients to fund big projects.
So the challenge for Cognizant, as we've kind of discussed throughout, isn't just grabbing the AI opportunity.
Yeah.
It's doing that while fighting off giants like Accenture and TCS, and at the same time figuring out how to deal with automating away parts of their own traditional business.
It really is an execution race against the clock of technological change. Which brings us neatly to our final summary.
Okay, let's synthesize this entire investment case. Chapter 7. Conclusion. Synthesizing the investment case. So the bull case, it really boils down to evaluation, doesn't it? You've got that low PE of 13.8 compared to its history around 20.4. You've got the new proven management team in place. You've got that rock-solid balance sheet, very little debt, and a company committed to returning capital to shareholders. Fundamentally, it looks healthy and, frankly, cheap.
The bear case is just as clear and centered entirely on execution risk.
Yeah.
Can this new management team actually pull off this incredibly complex strategic pivot, and can they do it fast enough? The competition, as you said, is intense. And the threat that AI poses to their legacy business isn't some future problem that's happening right now. It's an operational headwind.
So we circle all the way back to that core question and our valuation. Our intrinsic value range, that $85 to $95 per share, still feels pretty solid. And just for listeners, maybe those who don't run DCF models every day, we got there using what feel like fairly conservative assumptions.
Right. We modeled only mid-single-digit growth in free cash flow.
And the long-term growth rate we used was just 2.5%, which is barely above historical inflation rates, really. So it builds in a decent margin of safety.
And at the current price, around $68 or around 3 cents, that does offer a substantial margin of safety if management succeeds. So the investment decision here really boils down to this. It's fundamentally a bet on the new management team's ability to successfully execute this strategic pivot. Moving from that old cost arbitrage model to a new AI-driven value model, if they succeed, the returns could come from two places, actual business growth and the market potentially re-rating the stock, giving it a much higher PE multiple again.
Okay, so here's a final provocative thought for you, our listener, to mull over. We know high client switching costs are Cognizant's main moat right now. Given that, how much more pressure does that put on them to deliver genuinely superior, maybe even proprietary AI driven results? They need to make sure clients stay locked in, especially as automation starts eating away at the old labor model that built those relationships. It's about the difference between just maintaining that moat and actually letting it erode. Something to think about. Well, thank you for joining us on this deep dive into CTSH. And remember, this kind of analysis is just a sample of what our members get. Please like and subscribe to Stock Analytics AI. Remember, 4.99 euros a month gets you those 500 deep dive videos on the S&P 500. NASDAQ 100 is coming next. And don't forget, you can drop a ticker request in the comments. We'll try to turn it around for you.
And just the necessary disclaimer, please remember, this analysis was generated by an AI system using public source material. It's purely for educational purposes. It should absolutely not be considered financial advice. We strongly urge you to conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.